This is your Lead Left vodcast for the week of July 24th. I'm Randy Schwimmer. Well, welcome back. This space has covered at length the investor-friendly changes in senior debt terms since the Fed began its rate hiking regime in March 22. We recently spent time speaking with junior capital providers about the state of mezz terms today. Junior capital spreads have widened out 50 to 100 basis points from the end of last year to the end of the first half of 23, a top New York City manager told us. At the same time, leverage has declined 1/4 to 1/2 a turn of EBITDA. That's a similar dynamic to what we've seen in the senior debt market. It's simply a function of how much debt borrowers can handle. How about equity cushions in new LBOs? Purchase price multiples are still elevated, another manager reported. Cash equity percentages have remained healthy, even rising slightly, as sponsors have focused on prudently capitalizing businesses in the face of rising rates. Other elements of junior capital pricing are at or better than pre-hike levels. Closing fees and OID have been very stable at around 3% this year, a Chicago-based direct lender said. That's up from an historic norm of 2 to 2.5%. We're also seeing improved call protection. Non-calls for year one were virtually non-existent from late 2020 through fourth quarter of 22. Now we're getting that plus 3 years of call protection on most of the deals we're doing. What about PIK toggle options? Junior capital managers have been more flexible with the combination of PIK and cash they've been willing to provide. Our sponsors are keenly interested in flexible structures that allow them to toggle to a more non-cash pay component if needed, they said. Other bankers agreed. We saw that being played out in a public way against the backdrop of higher rates with the now dead Cotiviti deal, one told us. The $5.5 billion unitranche reportedly had a PIK option for a large part of the debt. There are increasing opportunities to get creative and provide borrowers the ability to conserve cash to service interest expense in this period of high SOFR rates. Our own junior capital team has participated in this trend. One colleague told us, "We've closed a couple of deals this year with a 13% coupon comprised of 10% cash and 3% PIK. The borrower has an option to pay only 7% in cash in exchange for a coupon bump of 1%, bringing the total coupon of 14%. How has your underwriting changed with these tougher interest rate conditions? We've always done cash flow modeling focusing on fixed charge coverage and interest coverage ratios, he said, but in this environment, we're focusing on opportunities with over 1-to-1 fixed charge ratios in downside scenarios." Reporting from the non-call center at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.